Welcome to today's tutorial on the risk-free interest rate, a fundamental concept in finance that affects investment decisions, pricing of financial instruments, and economic forecasting. The risk-free interest rate is the theoretical return on an investment with zero risk of financial loss. It is used as a benchmark rate in various financial models, including the Capital Asset Pricing Model, CAPM. In practice, the risk-free rate is often represented by the yield on government bonds, such as U.S. Treasury securities, considered default-free. Let's examine the historical yields on U.S. 10-year Treasury bonds over the past decade to understand how the risk-free rate has fluctuated. The risk-free rate serves as a baseline for assessing the required return on various investments. According to CAPM, the expected return on an investment is the sum of the risk-free rate and the risk premium. Consider an example where the risk-free rate is 2%, the market return is 8%, and a stock's beta is 1.5. What is the expected return on the stock? Using the CAPM formula, expected return equals 2% plus 1.5 asterisk, 8% to 2% equals 11%. Next, let's discuss how the risk-free rate impacts the valuation of bonds. The price of a bond is inversely related to the risk-free interest rate. When the risk-free rate rises, bond prices typically fall. For instance, consider a bond with a face value of $1,000, an annual coupon rate of 5%, and a maturity of 10 years. If the risk-free rate increases from 2% to 4%, the bond's price will decrease. Let's use the bond pricing formula. PV equals C asterisk 1, open parenthesis 1 plus R close parenthesis to the power of negative n, slash R plus FV slash open parenthesis 1 plus R close parenthesis to the power of n, where C is the annual coupon payment, R is the discount rate, N is the number of periods, and FV is the face value. When the risk-free rate is 2%, the bond price is PV equals $50 asterisk 1 plus 0.02 caret dash 10 slash 0.02 plus $1,000 slash 1 plus 0.02 caret 10 equals $1,091.64. When the risk-free rate rises to 4%, the bond price becomes PV equals $50 asterisk 1 plus 0.04 caret dash 10 slash 0.04 plus $1,000 slash 1 plus 0.04 caret 10 equals $925.49. Not only does the risk-free rate influence the valuation of bonds, but it also plays a crucial role in the discounted cash flow, DCF, valuation of stocks. In DCF analysis, the risk-free rate is used as a component of the discount rate, affecting the present value of future cash flows. Let's use DCF to value a company expected to generate $200,000 annually for the next 3 years. With a terminal growth rate of 3% and a discount rate comprising a risk-free rate of 2% and a 6% risk premium, DCF PV equals CF1 slash open parenthesis 1 plus R close parenthesis to the power of 1 plus CF2 slash open parenthesis 1 plus R close parenthesis squared plus CF3 slash open parenthesis 1 plus R close parenthesis cubed plus terminal value slash open parenthesis 1 plus R close parenthesis cubed. With a 2% risk-free rate and an 8% discount rate overall, DCF PV equals $200,000 slash 1 plus 0.08 caret 1 plus $200,000 slash 1 plus 0.08 caret 2 plus $200,000 slash 1 plus 0.08 caret 3 plus $200,000 asterisk 1.03 forward slash 0.08 to 0.03 forward slash 1 plus 0.08 caret 3. When you calculate, you get DCF PV equals $185,185 plus $171,605 plus $158,896 plus $1,725,426 equals $2,241,112. Thus, the company's value today based on future cash flows, considering the risk-free rate, is approximately $2.24 million. Now let's answer some common questions about the risk-free interest rate. Question: why do risk-free rates vary between countries? Answer: risk-free rates vary due to differences in monetary policy, economic conditions, and sovereign creditworthiness. Question: can any investment truly be risk-free? Answer: no investment is truly risk-free, but government securities are considered close due to the low risk of default. In summary, understanding the risk-free interest rate is essential in financial modeling, bond valuation, and investment decision-making. It provides a foundation that helps investors assess the required returns for taking on additional risk. Thank you for watching. Don't forget to like, subscribe, and leave your questions in the comments.